Good morning, everybody. My name is Sabaha Mabua. Together with my team members, Letogonolo Kutani and Mosi Toboke, and we will be presenting the financial performance analysis of Botswana Bureau of Standards, a public limited company. Before we start, I'll just take you through our overview of our introduction. That will be starting with introduction of our group members, which are already covered, and then the overview of the organization, the literature review that will be supporting our financial analysis, our SWOT analysis, recommendation, and lastly, we'll be talking about our conclusion. Moving on to the organizational background. So Botswana Bureau of Standard is a company that was established by an Act of Parliament number 16 of 1995. It is a parastatal organization that is governed by the Standard Council with representatives from the industry, government, research institutions, and consumer protection. It is governed also by the Standard Act number 16 of 1995, the Weights and Measures Act number 21 of 2006. Internationally, Botswana Bureau of Standard subscribes to international organizations like the International Organization for Standardization, which is the ISO, the International Electrotechnical Commission, which is the IEC, and the International Organization for Legal Metrology, which is OIML, and the General Conference of Weights and Measures, which is the CGPM. And then lastly, African Organization for Standardization. And then BOPS was established mainly to develop national standards and encourage quality assurance. Its mandate is to promote standardization and quality assurance, as well as testing and calibration of machinery to determine its accuracy. And then again, Botswana Bureau of Standards offers training and certification related to quality assurance and standardization. And lastly, it offers consumer protection. And then I'll move on to the literature. So before we start, we would like to define financial performance, which is defined by Sindum et al. 2022 as the return on investment and earnings that impact an organization's performance. And then we move on to define financial analysis, which is defined by Mbona and Yushen 2019 as the use of quantitative information from financial statements to develop relationships between the items reported by the company. Our financial ratios would be specifically zooming into liquidity, profitability, working capital, and efficiency and investment ratios, as we feel like these are the ones that clearly defined and can bring out a vast understanding of our financial analysis for the company. And then here we're going to talk about the financial ratios. Firstly, we'll define liquidity as defined by Lin et al. 2014 as the one that reflects the organization's performance through balancing the current assets and liabilities. And then under liquidity, we have two ratios, that is the gearing ratio and the current ratio. So the gearing ratio is the one that determines the company's financial structure and risk of insolvency through evaluating total debt over total capital employed. This one was referenced from Gardiner 1995. And then the current ratio, as described by Kibet 2021, assesses an organization's capacity to pay short-term commitments due within a year. And then we move on to profitability, which is defined by Suratmi and Ramawati 2020 as a measure that assesses management's overall efficiency as measured by the magnitude of profits in relation to sale. And then under profitability, we have the net profit margin, which is defined as the percentage of sales to net profit by Nariwari and Nugraha 2020. And then we move on to the working capital. Working capital is the capital of a business which is used in its day-to-day trading operations, calculated as the current assets minus the current liabilities as defined by Casimir 2010. And then we move on to the working capital ratio, which is the measure of efficiency of the working capital of an organization over time, defined as well by Casimir 2010. So what we have realized is that if the working capital rate is high, the profitability of the company as well will be, if the working capital turnover rate is high, the profitability will be high as well, because more sales will enhance earnings. This is supported by Padanawati 2021. And I'll hand over to my teammate to handle the financial analysis.
Good morning, panelists, everyone, and once again, welcome to this financial analysis of BOTSWANA Bureau of Standards. So as my colleague has already explained, there are ratios that we use to do this financial analysis, but just to give you a picture of what to expect when analyzing what happened in BOTSWANA Bureau of Standards in 2021, the company, like any other that operated in the COVID-19 era, experienced financial difficulties that we were able to see and notify by looking at the balance sheet, the income statement, and just going through the annual report. That is what we were able to understand and note behind whatever that went on in the company. So the first ratio that we're going to be looking into is the liquidity ratio. Liquidity ratios, the first one we looked at was the gearing ratio, which we calculated by dividing the long-term liabilities by the equity, capital, and reserves. So what we noted is that in 2020, this gearing ratio gave us 50%, and in 2021, it gave us 84%. Just to explain, every percentage that is below 100%, it signifies that a company is operating at low risk. And if it is higher than 100%, it signifies that a company is operating in a high risk environment. So since we noted that the Bureau was operating in a low risk environment, we took an observation that despite that both percentages are less than 100, the first one was 50, the second one was 84, it is approaching 100, which means the financial risk is increasing from 2020 to 2021, which is a good indicator that the company should look into its policies and see if it can amend it to stay low, because BOBS has to operate at a low risk environment. Now, looking at the current ratio is calculated by using the current assets and dividing them with the current liabilities. With this one, we're basically calculating how many times can our current liabilities that we have in the books cover the current, can be covered by the current assets that we have in the books. So looking at the financial statements, in this case, using the balance sheet, we were able to see that in 2020, it was 1.89, and in 2021, it was 0.9. What this basically means is that in 2020, the company was able to cover its current liabilities with its current assets almost twice and have a reserve. But in 2021, it barely even covered them because it was short of 0.1. So it means that assets they have were not available to cover the short-term obligations that the company had, which this means that it's giving a red flag, it's signifying that there are liquidity issues in the company. And then going to a profitability ratio, we decided that net profit ratio was the best to use in this scenario, and it is calculated by using your operating profits and dividing them by your sales revenue and expressing that as a percentage. I would like us to zoom into this ratio very well, because in 2020, it gave us a 33.1% net profit ratio. This means that looking at the sales revenue that was generated in 2020, the profits that were generated from the sales with 33.1%. But in 2021, this figure changed to a negative 153.8%, which means this is it's plummeting. It is changing the situation. It went from a positive net profit ratio to a negative one, and not just a negative one, but a significantly big one, which means that the sales revenue that was there was not able to generate any profits at all for the entity, and hence this this is a signification for the company to look deeper into how it can assess how it can improve its profitability. So from looking at what happened in the industry, COVID-19 restrictions were the ones that reduced internal revenue that was generated. So just to give you a background, BOBS is funded by its own internal revenue generated as well as government subvention. And it's also noted that government subvention was reduced as well in 2021. Hence, how the value is coming down so significantly. So in 2021, what we figured out is that BOBS gave out free standards and it gave out free sanitizer testing to the government and all the other parties that needed the services because there was a pandemic that had to be addressed too. The next ratio that we're going to be looking at is working capital ratios. So working capital basically means how does a company have enough money in the business on a daily basis to keep its operations going. So the working capital comes from how long it takes for you to get money from the debtors, and how long does your inventory stay on the shelf? How long do you take to pay your trade payables? So what we were able to see and analyze in our company, Botswana Bureau of Standards, is that looking at the table presented, in 2021 versus 2020, there were significant changes. Inventory days went up. That means inventory stayed longer on the shelf. Those standards stayed longer on the shelf. Trade receivable days, we had 145 against 101, which means now for somebody like yourself who might have been owing us, last year you would have taken 101 days to pay us, but in the current 2021, you take 145 days to pay us, which you can understand that it affects the working capital for a company to have people bringing in the cash in a time longer than before. And what you've noted also is that the trade payables, the time it took for us to pay, I'll keep referring it as us as if because I've assumed that it's us analyzing our business, is that we took longer time, or BOBS took a longer time to pay back its payables, 188 days as compared to 129 the year before. Basically, what this does to the whole entire working capital turnover is that in 2021, it was a negative 5.49. Any working capital turnover that is less than 1, it shows that there's inefficiency happening. And it is more than 1, it shows that at least we are able to operate within tolerable days, but the higher it is, the better for the company. So what we're basically seeing is that the company was not able to be efficient in 2021, looking at the financial statements. Looking at the fixed asset turnover ratio, what it did, it stayed constant. This one just basically analyzes that from the sales revenue generated in the year we're looking at, using the fixed assets that the company has it generated more or less revenue looking at the assets that it has? And this one is signifying that the company is efficient in using its fixed assets. So this helps us identify where the problem is and where the problem is not. And clearly it shows that the fixed assets is not where you're going to be finding your problems, but rather where you are now operating, looking at your operating costs. Now, this slide just basically goes on to explain that the working capital turnover in 2020 was 1.16, and in 2021 was a negative 5.49, as said in the prior slide. There's a very big observation that we realized in the company that we're analyzing, that there was a drastic movement in property revaluation. Companies may have properties that they carry at a value in the books, which is always taken from independent valuers. So now what we realized is that in 2021, as compared to 2020, there was a negative 463% decrease in property revaluation. So there was a loss of 105 million. And this is the part where that significantly contributed to the loss for the year coming to 106 million. So we noted that BOTS only does re-evaluations of their property every 3 years. And this in 2021 was the 3rd year of this re-evaluation, and they had to choose a new re-evaluator to come and do their re-evaluation. So that is it from me and my analysis from my team. I'll hand over to Messi to give us our SWOT analysis, our recommendations, and so forth. Thank you.
Thank you, team members. Good morning, ladies and gentlemen. I'm going to take over on the SWOT analysis. We identified the strengths, weaknesses, opportunities, and threats for BOTS using the financial analysis that has just been discussed by my colleague and the BOTS annual report for 2021. And in doing that, we identified under strengths that BOTS operates in a lower risk environment because BOTS is funded by government through grants. It doesn't request or need money from the private lenders. The other thing is that government support through securing grants. We have to note that this support by government makes it more profitable because it doesn't pay interest, since the interest of subventions are partly paid by government. Weaknesses: we identified that government subvention in Botswana were reduced in 2021. As discussed previously by my colleague, the subventions were reduced in 2021 because of the COVID-19 pandemic. Therefore, BOTS received lower grants from government. The revaluation, which is done after 3 years, as discussed by my colleague, this revaluation, which is done in 3 years, causes some inefficiency on the value of the properties. Opportunities: revenue diversification encouraged by government. BOTS as a parastatal is encouraged by government to go there, innovate new ideas of income generations so that it can increase in its coffers. Tax exemption. BOTS has been tax exempted. So this means that the funds which could be used for paying tax can be used in BOTS to carry out some other operations. Right. There is no provision for disaster relief. We have been informed by my previous colleague during financial analysis that the COVID-19 pandemic affected BOTS. This is because it used the funds that were not prescribed for pandemic. As such, if BOTS had disaster relief fund, that would cater for any unforeseeable circumstance. Another threat is the travel for physical inspections. We have to note that BOTS create or generate more income through inspections. These inspections are done by the inspectors. They have to travel either from Francistown or Gaborone countrywide to calibrate and certify the machineries. So due to COVID-19 pandemic, they were not able to traverse the whole country to do these inspections. Minimal were done. Recommendations. As a group, we recommended that BOTS has to do revenue diversification. Here, we said BOTS can consider revenue diversification strategy to curb the over-reliance on government grants. This is because we noted that the grant was reduced by 11% in 2021. So this reduction in 2021 led to the liquidity issues on BOPS. Therefore, the BOPS has to look into the new ways of generating income. 2, incorporate a disaster relief or response emergency policy and fund. As discussed previously, BOPS has to come up with a policy and a fund that has to look into future covers for pandemics, natural disasters, and unforeseen circumstances. This would be more ideal looking at the fact that BOPS was heavily affected by COVID-19 pandemic. Review of service level agreements, SLAs. We have noticed on the working capital that BOPS was taking time to pay its payables, about 188 days in 2021. So BOPS has to review this so that it can improve the turnaround time on the payable days, because prolonged payment delays the suppliers and it also affects them adversely. This can affect the relationship between the supplier and BOPS and may also reduce the competitive efficiency. And this also might expose BOPS to potential fines. BOPS again has to review the receivable days. On the previous presentation on the working capital, we identified that it takes 145 days to be paid by those who owe it. Therefore, it has to come to party with its receivables and negotiate terms to reduce the payment terms to its debtors. And again, we've seen that it has 233 days in 2021 on the stock holding of its inventory. So this has to be reviewed in order to assist in the working capital management. The other thing is the revision of the revaluation period from 3 years to 2. We have noticed that the revaluation decreased by 105 million, which is negative 463%. And as such, this increased the risk of losing on the value of the property and only realizing it in the 3rd year. That's why it has to come back to come to 2 years instead of 3 years. In conclusion, as a group, we said in 2021, BOPS faced challenging financial year due to COVID-19, which impacted on its revenue resources. We've identified that gross profit dropped by 32%, operating profits also dropped by 433%. There was negative 291 decrease in year-end products. There was inefficiency in working capital management. There is increase in financial risk, as we have seen that the gearing ratio increased from 50% in 2020 to 84% in 2021. And as such, there is need for stronger business control within BOPS. I thank you. I'll hand over to Sabaha for the next session. Thank you.
Thank you, everybody. We can now allow for questions.
Thank you for the insightful presentation. I think it was quite clear, but just for clarity on one aspect, the gearing ratio is of interest to me. How do you engineer the gearing ratio? Thank you.
Okay. Thank you for the wonderful question. So basically, just to give a brief overview, the gearing ratio provides an insight into the financial leverage of an organization. So for you to engineer it, you need to calculate to firstly define the two components that are very important. That is the debt and liquidity, and then you have to calculate them. And then after that, you can calculate the gearing ratio, which is the percentage of the total debt over equity. So basically, for engineering the gearing ratio, it just helps you make decisions in how related to how the debt and liquidity of the company. I mean, the debt and liquidity affect the company's financial statements. And then if you increase the gearing ratio, then that means it takes the company to more debt. But then if you reduce it, it then now makes profit for the organization. I hope that clarifies your question. Thank you.
No, I think that's clear. Thank you, Subara.
Does anyone have another one?
Hi, Subara. Hello.
Hello.
Yes.
A good presentation, by the way. My question is, how does a company like Bob's safeguard itself against such future losses as the one they experienced in 2021?
Thank you for the question. We have to note that losses are always part of the possible outcomes of every business. But to safeguard, but to be on the safe side or to safeguard against this, the team has identified the potential safeguards for Bob's, which are, as discussed in the recommendations, Bob's has to create a provision for disaster fund in order to pay or to be able to address future disasters or future uncertainties. Also, reevaluating more often or reevaluating frequently its credit facilities for debtors and part of the working capital to be reviewed. And again, we can safely say companies won't make losses again, and they won't be possible, but would be very important to do financial analysis.
Hello guys. Just to add on to what my colleague is saying on the second one, I believe that any company can always try to put itself on a safe side to avoid losses, and that is basically why we would do financial analysis in the first place. So that is made also by the fact that she's saying we can have a disaster relief provision is not the only provision that can come into the books. You make provisions for all uncertainty, and you make sure that you put it in the books so that should you have any issues, it does not come and hit hard your bottom line, as much as we've seen in Botswana Bureau of Standards. And basically what we also know is the fact that, revaluation has its own costs, but it has to be compared, or what is the cost of revaluing and issuing that independent valuer to come and do the work, as compared to finding out only on the third year that the value they had or they thought they had on the books is very much less than what actually is on the ground. So these are the kind of things that we need to do, and we need to just accept that a loss is part of things that can come through, but you just reduce the rate at which you see by just navigating spaces. Working capital management is one of the key elements of any business that needs to be looked into. Basically, you want stock to not last as long on the shelf. You don't want people to take very long to pay you, so that you can fund your own operations. So that is how you can do that. So working capital management is key, and I believe us highlighting that it's one of the things that can be used is how we can close that question. All right, thank you.
Thank you so much. That was well answered. That's all.
Okay, if we don't have any further questions, thank you guys.
Thank you.
Thank you.
Thank you.